Welcome, everybody. I'm Michael Episcope. I'm the co-CEO and co-founder of Origin Investments, and I'm your host today. I'm here with John Hoffman of Bracket Partners, and this webinar is about what to know about tax laws for QOZ investing. We get a ton of questions around tax laws, and John is here today to answer all of them. John is a CPA who provides financial and tax consulting services to help investors, developers, operating businesses, and other clients identify and maximize the value of tax incentives. He is an opportunity zone thought leader, especially as it relates to taxes and structuring of QOZ investments. He has more than 20 years of experience working on projects involving tax credits and incentives, and we are excited to have him here today. Thank you for being here, John. Now, I want to be clear that John does not work for Origin. He is not on retainer here. So if you have questions after the webinar and you reach out to him, be prepared to pay for his advice. It's happened after the last webinar, which was about 6 months ago. A lot of people reached out to John thinking he was on retainer. He's not. I can tell you, though, that the value he provides far exceeds the cost of his services. We reach out to John on a regular basis if we have tax questions on our end. In terms of the agenda, I'm going to go over Origin briefly and talk about our QOZ fund. And then John is going to go over everything tax related. He's going to talk about the QOZ basics, go over changes proposed under the Biden plan, some of the tax changes coming through, how that might impact you, and then talk about QOZ logistics, filing tax returns, all the different forms that need to be filed as well, all the fun stuff. And then we'll open that up to a question and answer session as well. Now, if you have questions along the way, please enter them into the Q&A box, not the chat box, and we'll get to those in real time and at the end as well. The whole webinar will be about 1 hour. I anticipate the presentation to be about 40 minutes and then about 20 minutes for Q&A. Now, this is a hot subject. We have more than 500 people attending this webinar today, and we want to thank you in advance for your questions. Most of those have been weaved into the presentation. John and I have looked at all of those and grouped them together into different themes. He's going to cover most of them in his. Some of these were, kind of related to the fund itself and maybe not applicable to this particular webinar. And I just want to be clear that this is not a fund update. This is specifically designed to answer QOZ tax questions. So if you can keep your questions limited to that area, that would be fantastic. And if you do want to learn more about the fund, you can check out our website at origininvestments.com. You can download the fund's materials there, or you can look at our last webinar, which was May 24th, or register for our next webinar, which is August 31st, where we will go over the QOZ fund in great detail. Let me jump in now to talk about Origin. We'll start the slide now. Okay, again, I'm going to just briefly talk about Origin and the QOZ fund. So today, Origin currently serves more than 1,600 individual investors, and our investment partners include everybody from registered investment advisors who send their clients to us. We have more than 30 of them right now who come to Origin as their real estate solution. We also represent family offices and individual investors that span the range from high net worth to ultra high net worth. And what we do is that we help your money work for you by providing tax efficient investments that generate passive income and grow your capital. Our entire investor base is the taxable investor, which is why QOZ makes so much sense for us, makes sense for us to launch in the first place. Because from an after-tax perspective, there's really nothing that comes close to QOZ. And John is going to get into more of the details about a QOZ investment versus a non-QOZ investment and talk about the after-tax benefits of that. But David and I are excited about this program and our fund, which is why we've already invested more than $10 million of personal capital into our first QOZ fund. This is the largest investment we've made in any of our funds, and we will continue to push money into this fund and our next fund as we find more capital gains in our tax returns. The QOZ's fund's strategy is what we call a build to core strategy. And what that means is that we are developing a portfolio of Class A developments that will be stabilized and then held for 10 or more years. And when the fund is complete, we anticipate that there will be about 8 to 10 Class A multifamily developments in the fund. And I do want to be clear that the fund is 100% multifamily. There's no office, there's no retail. By the very nature of some multifamily, we might have exposure to a little bit of retail on the mixed use side because zoning requires us to do that. But generally, 95% of this fund is multifamily. We are generally targeting growth cities in Sunbelt markets. So if you look at that map, what you see is what we call the smile. So all the way from Phoenix through Texas to the Southeast, Atlanta, Charlotte, and then Florida. Those are the areas that we're investing in today. We have around 30 team members at Origin who help with everything from executing our strategy to servicing our investment partners. And in terms of performance, we have consistently been in the top quartile in all of our funds. And it's going to be no different for our two funds that we operate now, our Income Plus Fund and our QOZ Fund. Our expectation is that we will outperform 75 to 80% of other managers. That's what we're here to do. Our base case projection in this fund is a 2.5x net multiple over 10 years, and that is on a pre-tax basis. And what that means is that if you make $1 million commitment to the fund, first of all, you can invest that all on day one, and you can expect that to grow on a pre-tax basis around $2.5 million. To date, we've raised $230 million in this fund, and we've recently decided to hard cap this number at $300 million. So the fund will be no larger than $300 million. We've gotten a lot of questions about this, so that's the answer. And by the rule of law, we cannot accept new investments after 12/31. So it's really 12/31 or $300 million, whichever first, and most likely $300 million will come first based on how quickly we've been raising capital. And the real reason for that is that as we manage our pipeline against our capital raising, we don't want to be investing any of this capital past 2022. There will be some deals in our pipeline that bleed over into early 2022, but we don't want to have capital sitting there waiting for deals that are going to break ground in 2023. And then we will launch Fund 2. So that's a little bit about Origin, a little bit about the QOZ Fund as well. If you want more information, please tune into our webinars. John, I'm going to pass this over to you now, and you can talk all about QOZ tax law. Thank you.
All right, thanks, Michael. Appreciate it. So as Michael alluded to, we did a somewhat similar webinar about 6 months ago, back in early December. And if you recall, in early December, we had just learned that Joe Biden is president, even though there's still a lot of political contention. Obviously, it's 6 months later. Here we are. Things are starting to improve clearly from the pandemic standpoint. We've seen a lot of legislation relief and other things that have come out of Washington, D.C. that have been funneled from the federal government and into the states and into the cities and so forth. Through all of this, it's probably no surprise there's going to be tax reform at some point that's going to be done here. It's likely going to be pushed through either later this year or sometime early next year, so that all of our politicians in Washington can spend some time on campaigning more next year for the midterm elections. It's probably no surprise to anybody on this webinar that there's been a lot of speculation about what is going to happen to tax rates, new taxes, revised taxes on everything from the corporate income tax rate to capital gains tax rates to infrastructure, so on and so forth. So we're going to dive into that, and we're going to talk about compliance issues and a lot of things that you all want to think about or need to think about from a strategic perspective, but also to deal with, if you've made investments already into this Opportunity Zone Fund and you're contemplating additional investments, things that you'll want to consider. With that, I think it's always important to cover the basics of what the Opportunity Zone benefits are. I meet with, as Michael alluded to, I've been in the world of tax credits and incentives for over 20 years of my career. Opportunity zones came out at the end of 2017 with tax reform. There wasn't much about it until people started doing some research in early 18, and then this program has really taken off since then. However, I do want to reiterate that this this program, this tax incentive is fairly new. We got several rounds of guidance that came out in 18, and then the final regulations came out at the end of 2019. So, the program is still fairly new, but there has been significant capital that came into the program in late 19 and all of 2020, and certainly this year. And a large reason for that is because there are a lot of people, individuals primarily with capital gains, that want to take advantage of these benefits. So let's talk for a minute and review what the benefits are. So again, there's three primary benefits to investing in opportunity zones. There are two benefits related to the capital gains tax on what I'll call your old gain. And then there's one very lucrative benefit on the increase of your investment in the Opportunity Zone Fund. So let's talk about the two benefits related to your old capital gain. So let's say you have capital gains, you invest in an Opportunity Zone Fund, you get two main benefits. If you get that money, your capital gains, into a fund by the end of this year, what you'll be able to do is you will be able to defer the taxes you would have to pay on that capital gain here, let's say this year. You'd be able to defer it all the way out until 2026. So you get to defer it for approximately 5 years. The other thing that you get if you get your money into a fund by the end of this year is that you get a step up in basis such that your capital gain is reduced by 10%. And consequently, the tax that you will pay, the capital gains tax that you'll pay in 2026, is reduced by 10%. So those are two benefits. One is deferral and one is a reduction by 10%. Those are obviously helpful, but by far the biggest benefit is you put your capital gains into an Opportunity Zone Fund, and the fund does what it's supposed to do, and presumably that investment increases in value, as Michael alluded to. And whatever the gain is, the capital gain on your investment, as long as you keep it in the fund for over 10 years, that gain is tax-free. So when Michael talked about a 2.5 multiple, basically you put $1 million in, and after 10 years, it's worth $2.5 million. That $1.5 million and perhaps some additional benefits could all be tax-free. So there'll be no tax to pay 10 years from now. So by far, that's the biggest benefit of what the Opportunity Zone program is. And as you can imagine, most investors that are putting money into Opportunity Zone funds are interested in making sure that that capital gain is as large as possible, because there are no other tax benefits or primary tax benefits that are related to investing in opportunity zones. So for example, if you're getting a preferred return or if you're getting distributions and so forth, there are no special tax benefits to those of being in an opportunity zone, at least not yet. All of the benefit is on the future appreciation of what your gain ultimately would be in this investment. So I want to clarify a couple points on this, because I get questions on this every couple of days. The tax benefits for opportunity zones are only related to eligible capital gains. So you can't take dollars that are non-capital gains and get the same tax benefits. Michael, not to put you on the spot, but I'm assuming that your opportunity zone fund only accepts qualified capital gain dollars in the fund, right? You're not accepting non-capital gain dollars in your fund?
We actually do accept non-capital gains dollars, but 99.5% of our fund is capital gains dollars.
Okay. Okay. And there's a lot of reasons why funds may accept it, but again, the tax benefits only come to the capital gain dollars. So that's something that's really critical to think about here. When we talk about qualified opportunity zone basics here, many of you have capital gains that you find out at various points during the year, right? So you might have a situation where, let's say you actively trade stocks, right? Some of which you hold for short term, some of which you hold for longer term. And when you sell that stock and you have a gain, whether it's short term or long term, in general, you have 180 days from when that gain is recognized for you to invest those funds in a qualified opportunity zone. That's fairly common. A lot of investors do that, but it makes it a little bit complicated because if you're constantly trading and constantly generating gains, you constantly have to be monitoring, well, I had 180 days from that gain, so I need to make sure that I put it in a fund within the appropriate period of time. So for example, let's say here in January of this year, you did some type of stock trade and you generated gains. You have 180 days from when that gain was recognized to put your money in an opportunity zone fund. You cannot wait to the end of the year. You cannot wait until March of 2022 when you're filing your tax returns to say, oh, yeah, I did this stock trade back in January of last year. I think I want to put some money in an opportunity zone fund. If you get to that point, your 180-day period is passed, so you're out of luck. The other thing to think about is for the timing of the gains is, let's say that you owned a business and you at some point decided to sell that business. In general, you have 180 days from when you sell that business for you to invest those capital gains into a qualified opportunity zone fund. Okay, so I've worked with a variety of clients, and I continue to do so, where they sell a part or they sell a business in its entirely, or let's say they're fractional ownership in a business. You do a lot of planning. It's a lot of work to get that point, but you need to be mindful that if you want to defer those gains, you need to look at your 180-day window and be very mindful of that. So those 180-day timelines are pretty tight for those types of capital gain events. On the flip side, many of you have investments in various partnerships, and those partnerships will issue a K1 every year, of course, and they will provide, on those K1s, it'll show you that you have various capital gains. Fortunately, for a partnership, you have a little bit of time for your 180-day window. In general, you have 180 days from December 31st, assuming you're a calendar year taxpayer, in order for you to get that money in a qualified opportunity zone fund, in general. This past year and a half, we've had a variety of COVID relief bills that specifically, I'll say, help or target both opportunity zone funds and opportunity zone investors. But in general, if you received a K1 for 2020, and let's say you have not filed your tax returns yet, you have 180 days from 12/31, which means if you want to defer your capital gains, you need to get that money in a fund in the next couple of days. And remember that it's 180 days. It is not 6 months. So it is not June 30th. It is effectively, if I did the math right, it was June 28th this year. So that's something to be thinking about over the next couple of days, if that's what you want to do. A question that often comes up related to the 180 days is that, let's say you had a capital gain at the end of the year, you received some K1s, and let's say you timely filed your tax return on March 15th or April or May. It was extended this year, obviously. And now all of a sudden you're listening to this webinar, or you talk to a few friends or colleagues and you say, uh-oh, I had these capital gains, I was going to pay the tax, but now I think I want to defer some of that capital gain and I want to invest it in an opportunity zone fund. You can still do that, but you have to amend your returns. So just keep in mind that it's not too late. You do have a few days to do this, but you're going to obviously want to talk with your tax preparer, and you're going to have to move quickly. So that's a question that we get quite a bit, and I think we had that here. So those are some key things to think about. From an investor's perspective, is that 180-day window. When does your 180-day clock start? Because it's really important. The IRS has, in the last year or so, they've issued a variety of what they call private letter rulings for both opportunity zone funds as well as opportunity zone investors, in which they might have made an administrative mistake or other thing, and they're trying to ask for relief to say, hey, look, I meant to do this, here's what happened, but for whatever reason, I couldn't get the money in, or I didn't do that, and so forth. That option might be available to you, but it costs money to get a private letter ruling. So I strongly suggest that if you want to defer these gains, you need to quickly look at your 180-day window and make sure that you comply to that. With that, can we move to the next slide?
Hey, John, before we move on, there's a
Sure.
couple of questions that came in that I want to just answer in real time. And one of them has to do with what is your tax rate going to be in 2026, or are you subject to today's or tomorrow? And I can answer that. And really, from a federal level, it's whatever the prevailing tax rate is in 2026, that's what you will pay at that time. Now, the next question, which I got this last week and I didn't know the answer to this, let's say that you live in New York right now and you're in a qualified opportunity zone fund, or a city that actually recognizes the federal law and plays along. Then you move to Florida. Do you pay taxes in New York or do you pay taxes in Florida?
That's a great question. I don't know the answer to that for sure. I think that the opportunity zone, the federal opportunity zone regulations, of course, are not going to touch that at all, right? That's a state issue, right? So it's going to be dependent on what the states would adopt. So that would be a similar tax where, all right, if I move from one state to another at some point down the road, it could be a capital gains issue, it could be an income issue, it could be all kinds of other issues. It could be a 529 plan and so forth. You'd have to look at the actual state law for that particular state to see what they're going to do for this. It's interesting, Michael, on a related point, you brought up New York. New York had fully adopted the opportunity zone benefits, but I do believe that I read something about a month ago that I think New York is now decoupling from opportunity zone benefits. And, this could happen in other states. You have to look at each state to see if they comply entirely with the federal opportunity zone benefits or regulations, if they specifically decouple from certain aspects of it. So it does get fairly complicated in various states. And of course, states like New York, California, and some other states that have very high tax rates, it makes a real big difference for sure.
Right, right. And there's another question here, and maybe it's just a point of clarity about how non-capital gains, when you're investing in the fund, if you don't have capital gains, you don't get the benefit. So it's not about the assets are being sold tax-free. It's about the investor's interest in the fund that is treated as tax-free. So when we've had investors who've come into our fund that have used non-capital gains, and we track them separately, but you will absolutely have to pay taxes on whatever those gains the same way you would in other funds. And people have come into our fund because they like the strategy, they like the income component in a few years, but there is no tax benefit more than just general real estate if you invest in our fund or any QOZ fund out there with non-capital gains. So I just want to be clear about that. John already covered it, but there was a question that came in as well. So thank you.
Yep. Yeah, that's very important. So, as part of this, webinar, obviously we're going to talk about, various technical aspects of opportunity zone investing. We're going to talk about some of the tax reforms, answer a lot of different questions. But, the other thing that's a really big issue is, what's going to happen here with proposed tax reform? So we're going to touch on some of those things as well to talk about what's out there and what that could mean for opportunity zone investing. We included this particular slide. Some of you may have seen this last week. There was an article in the Wall Street Journal that talked about capital gains, and it had this fairly interesting graph here. And it looks at the tax rates for various types of taxes, right? So we're looking at, in blue, it's the income tax rate. In gray, it's the corporate tax rate. And of course, then in, I guess it's purple/red, it's the long-term capital gains rate. And keep in mind, this is probably no surprise, but in general, short-term capital gains taxes are taxed at the ordinary income rate. So, but when you look at this, you can see that, our federal income tax rate has been all over the board, right? It was obviously very high during the 40s and 50s and into the early 60s. And then since then, it's generally gone down significantly. The corporate tax rate, which really isn't all that relevant for opportunity zone investing, is kind of bounced around as well. I think, it was a surprise to almost everybody that it went from the rate it was at in 2016 to go down to 21%. I don't think many people thought it would go that low. And currently the Biden administration is proposing to raise that tax rate, not all the way back up to 35 or higher 30s, but to raise it up to the 28% rate. But you can see in here what's transpired over the years for the long-term capital gains rate. So based on this graph here, the highest long-term capital gains rate we had, which is obviously really important for opportunity zone investing, was approximately 35%, and that was in the 70s, right? So we've never had a capital gains tax rate based on this chart that was higher than the individual income tax rate. Okay, so and even for a while, 10, 15 years ago, we had a 15% rate, so it was quite low. It's probably, if you've read anything in the Wall Street Journal or other publications, you can see that Biden's proposal is to raise the capital gains, the long-term capital gains tax rate up to the highest personal income tax rate. And right now, what I'm reading right now from the Tax Foundation is what they're trying to do is raise the top marginal income tax rate from 37 to 39.6. And of course, the long-term capital gains rate would match that 39.6. Of course, short-term would as well. And then on top of that, you would have the 3.8% net investment income tax. I haven't seen anything that is proposing to raise that net investment income tax rate. But right now, I think just about anything's on the table. So that would make a very big difference, whether or not you're investing in opportunity zones or not, because if that rate goes up significantly, it's going to make a big difference to anyone that has, significant capital gains. Now, they have said that that is for taxpayers with adjusted gross income above $1 million. Obviously, that could move. This is all proposed tax laws, but you can see that they're really trying to, for lack of a better term, attack what they perceive as a fairly low long-term capital gains tax rate. As part of this, even when we did the webinar last December, I did some running of numbers to take a look at and say, what happens if our capital gains tax rate goes from 20 to 30 or 20 to 40 or 20 to 50? And in general, the assumptions matter and so forth, but in general, it appears that investing in the Opportunity Zone program is still better, even if the tax rates, the long-term capital gains tax rate jumps into somewhere into the 40s. It still appears to be a better overall investment going in an opportunity zone than a non-opportunity zone. Many questions that we get, and Michael, I'm sure we've got 5 or 10 of these, is, okay, if I invest now and the long-term capital gains tax rate is 20%, and let's say the rate jumps in 2026 to whatever it might be, it appears that I have to pay the capital gains tax rate in 2026, right? We've answered that question many times. We also get the question is there any way to lock in the rate now? Can you somehow pay or set an escrow of paying your long-term capital gains tax now, somehow to preserve that rate? And the IRS has been crystal clear on this, that the answer is no. You are going to pay the prevailing tax, long-term capital gains tax rate on your old gain, either in 2026 or earlier if you were to happen to sell your investment in the fund, or if you had some other type of income inclusion event prior to 2026. So, it is obviously a wild card. It's certainly possible that long-term capital gains tax rates could go down in 2026, right? We don't know. The net income investment tax rate could go down as well. So that's certainly a possibility as well. Keep in mind that after 10 years, the benefit of the Opportunity Zone program is that you don't pay any capital gains tax, right? So if the capital gains tax were to even go higher in 10 years than they were in 2026, anything's possible. Again, the benefit of the Opportunity Zone investment is even stronger. So, but again, we're all looking at this without a crystal ball about what's going to happen to tax rates. We don't know what other types of things are going to be part of this. We don't know if there's going to be proposed tax changes to the Opportunity Zone program that might institute other taxes and so forth. But based on what we know right now, it is pretty clear that Biden's proposal is trying to significantly increase the long-term capital gains tax rate. Michael, do you have any questions or comments you want to post on this that while we have this slide up?
Oh, there's a lot of questions that are coming in, John. So nice job. Somebody obviously pointed out that, when you're looking at the income tax rate for individuals, obviously that can be pretty daunting in the 50s. And certainly, most people didn't pay that rate, right? The effective rate was far different. And maybe you know this offhand, John, after tax shelters and everything else, what has been sort of the range of long-term, the effective tax rate for individuals?
Boy, that's a good question. I'd have to research that, but it's generally been in the 30-some% range, right?
Right. Yeah.
So
90s.
And that's reflective in what you see here.
Yeah, and I would say after the Tax Reform Act, so when you look past like 1985, that point, everything's pretty accurate here. Everything before that was, the tax code was extremely complicated, and the marginal tax rate looked much higher than the effective tax rate. So that is absolutely true during that point in time. And I want to just remind people to submit questions in the Q&A and not the chat. We're getting a lot of questions in there as well. So we've got questions coming through, and we will answer those in real time as we go. But John, the floor is yours.
Yeah. One other point on this, Michael, maybe people are asking this too. We kind of touched on a little bit, is obviously this chart doesn't show anything that's happened on the state side. And I think that I'd have to see a chart, but my gut says that over the years, the amount of taxes that individuals pay on the state side, you would probably see this trend line just going up over the years.
Yeah.
Right. I think.
So, John, maybe you can clarify this, because I know this is a question that came in, and I know there's been some IRS rules, and they've been pushing back some of these deadlines. But this is from Mitchell, and he said, I heard that that you are allowed until September 15th to invest capital gains for the previous partnership year. Is it June 28th or is it September 15th?
Yeah. So what the COVID relief that came out was crystal clear that last year, so in 2020, you had until September 15th, which of course was the extended due date filing. I'd have to double check if it's if it's the same this year. I did take a look at the revenue ruling, or the notice that came out was called 2020-39. I don't think I've seen an update on that, but I'll double check and we can follow up with that after the fact.
Okay, yeah, because investors may actually have until September 15th if the IRS push things back due to COVID. So this is a very exceptional year, but generally it's going to be 180 days from 12/31. And there are actually two questions regarding this. So when your taxes are due in 2026, if you have losses in 2026, will those offset whatever taxes you owe, you're going to pay in 2027, carry forward losses in that year, et cetera?
Yeah, I think the answer to that is yes, right? So what's going to happen to investors in 2026, the way the law stands right now, is, you're going to look at your entire tax situation for that year, right? And you're going to have to make estimated payments, taking into consideration of, I've got to pay the capital gains tax on these capital gains that I deferred back in 2019 or 20 or 21. So you're going to want to take that into consideration. But you might have other things that are happening in 2026 that would say, okay, I've got to pay this capital gains tax on my old gain from years ago, but this year I have a variety of losses or other things that are happening in my situation that would offset the tax that I would have to pay.
Right. And John, I don't know if you're an expert in estate planning, but there's obviously when a lot of people are investing for the next generation, and if an investor should pass before that investment reaches 10 years, how is that handled by the estate? Does the estate get the tax benefits so long as it remains invested?
Yeah, so I'm going to preface that as I am absolutely not an estate planning expert at all. So I would strongly consider anybody on this webinar to consult your personal CPA, tax attorney, whatever it might be. But generally, and we covered this question 6 months ago because it does come up a lot. And what the regulations have said is generally, if a taxpayer dies and they have their money invested in an opportunity zone fund, it is not an inclusion event, and your heirs would get a stepped up basis. So, and I even think that the IRS, this is probably a plug for what they have done, which I think is pretty good, is many of you probably looked at this on the IRS website. they have a page that's related to frequently asked questions. And they have a lot of good questions and answers on there. By no means is it going to answer all of the questions you have. And I do think that the IRS will update that page from time to time. But you can always go there to look for some answers on this. But this particular question, I think the IRS has pretty definitively answered that says it is not an inclusion event and you get a stepped up, or your heirs get a stepped up basis.
Got it. Thank you. I'm going to answer this question really quickly. We get this a lot. People want to know if they can preemptively invest in the QOZ fund with the idea that they're going to have a capital gains in the future. And the answer is no. Your capital gain has to be realized before you invest in the QOZ fund. So we have had a lot of questions. We've actually had investors invest, getting some, potentially bad advice, and then having to unwind that investment later on because it doesn't qualify. So you have to realize your investment and then make the investment.
Yeah, that comes up a lot. Now, with that, I do want to say that, the dollars are somewhat fungible, right? So if you have a scenario where, let's say on December 15th, you realized a gain, and December 17th, you want to immediately invest the money into an opportunity zone fund, you can do that very quickly. And you could take money from some other account, whatever it might be, right, that you might have, and invest the money. The money is fungible, but you cannot put capital gain dollars into an opportunity zone fund before the gain event has actually occurred. So
Right.
It's really important.
And this is another question, and maybe I'll just talk about the fund a little bit because there were a couple of questions. Our fund, once we're done building all of our properties in there, we will be refinancing them and sending that money back to investors. And even in a non-QOZ fund, refinancing proceeds are non-taxable. So this fund gets all the benefits of depreciation. We're tracking that. They get the benefits. Investors get the benefit of non-taxable refinancing proceeds. And though that money does come back to investors to obviously help everyone pay their taxes in 2026. And you have to pay your capital gains tax in 2026, no matter if you stay invested. I'm not quite sure what that means, but you are going to be required in 2026 to recognize that gain and pay those taxes. So it has nothing to do with money coming in or out. Certainly, if you get out of the fund before the 10 years in one day, you don't recognize the benefits of not paying taxes on your gain in the fund as well. So that's just a little point of clarity there.
Yeah, and so I guess the real critical thing, and I'm sure, Michael, when you are, having prospective investors invest with you, is that, look, your money is coming into this fund and you're going to be locked with us for at least the 10-year period, right? And that's really important, because if you think about the spirit of this program, the idea of the program is they want to see long-term patient capital invest in these areas and make real investments in improving property, adding jobs, make a real economic impact. What they're not looking to do is say, you put a bunch of money in here and you flip something and in 2 years you're out and so forth. They want to see long-term capital, and that's why they have this 10-year restriction.
Yeah. Okay, and the last thing I'll say, you can stay on this slide right here because this is John's next point, but whatever your gains are that you recognize in this year, whether they're short-term or long-term, that's what they will be subject to in 2026. So if you take short-term capital gains and elect to invest those in a QOZ fund, then you will be recognizing short-term capital gains in the future, whatever those prevailing rates. Same with long-term. So they don't change based on you're not investing short-term today and then recognizing long-term in the future, or vice versa.
That's right. Yep. That question comes up all the time to say, hey, is there a way I have a ordinary capital gain now, will it turn into long-term capital gain in the year 2026? And the answer is no, based on the current regulations.
Yeah, and honestly, ordinary or short-term capital gains are far better because, there's a likelihood, maybe not as much, based on the chart you showed, that long-term capital gains rates are going to go up significantly. What that means, we don't know, 30, 40, 50%. But short-term capital gains are already at the highest rate. So yep. I've always, when I've talked to people, if you have short-term capital gains and long-term, you definitely want to put short-term in here, versus paying them today, because the NPV or that sort of interest-free loan for 6 years is far greater than an interest-free loan on something that's long-term capital gains that's only being at that 20% rate.
Yep, 100%, 110% makes sense. We included this particular slide to just show the states, and we've talked a lot about the federal benefits, but we also touched on some of the state benefits here. Obviously, this is also from the Tax Foundation. It's kind of looking at what would happen, for the combined tax rates between federal and state. The reality is these colors would pretty much stay the same, even if capital gains rates stay where they at right now. The reason why I say that is because it's probably no surprise. You look at these states that are in the darker red, they're the ones that have higher capital gains, state capital gains rates right now, right? So all things being equal, if you're in California or New York, New Jersey, and so forth, you're paying the highest capital gains, state capital gains tax rate, and that's likely to continue in the future, even if capital gains rates goes up. So no surprise there, but we just thought we'd illustrate that.
So John, let me ask you a quick question here. Go back to the question. So Yuri has a question. How can capital gains from multiple sources be combined? You want to take that?
Yeah. So what happens when I've worked with a variety of clients when they're saying, look, I've got capital gains from different things here, right? I've sold some stock, or I get some K1s and so forth. And, especially if you're an active, let's say, stock trader, how do I handle this, right? There's every month you might be having gains and so forth. Well, the reality is that you have to monitor the 180-day window for each of those gains. But when you actually do the reporting on the tax, on your tax return forms, you can consolidate those gains. You don't have to list every single trade on there and say, okay, well, on January 30th, I did this, and then February 5th, I did this, and so forth. You're able to consolidate those, but you're still subject, unfortunately, to the 180-day requirement of when that gain was realized, you had to, get your money into a fund within that 180 days. I think that's an unfortunate part. It's a disconnect, in my opinion, and I think it makes it very cumbersome to investors, because I wish the IRS would just go to the mindset of saying, look, 180 days from 12/31, or heck, by September 15th of the following year, by then you'll know what all your gains are, what all your losses are. You just have to have your money in a fund by that. However, they haven't made that change. That's not the way it works. The good thing, though, is on the reporting side, you can at least group your gains together, at least for various stock trades or trades or gains that are of the very similar nature. On the flip side, let's say you have a lot of different capital or K1s that are coming in. When I've read through this, it appears that the IRS still wants you to list each K1 where you're getting gains from. So that could be troublesome. If you have 30 different K1s that you're getting, you need to list each one of those K1s. So, and if you look at the various forms that are out there, which we're going to talk about on the next slide, you're going to have to insert a supplemental schedule for all of those different K1s where it's coming from.
Yeah, this is the fun stuff. Let me ask you a quick question, though, John. You can stay on this page, Jeff. If a partnership sells, this is from Chris, if a partnership sells an asset for a gain, can the pass-through partner invest those gains immediately, or do they have to wait until the year end when they receive their K1s? We get this question actually quite a bit from our Fund 2 and 3 investors. So John, I'll let you take this, and then I'll maybe add something to this as well.
Yeah, so the answer to that question is generally yes. If you know that your partnership that you're invested in just did something that created a capital gain, you can invest those funds, even though you don't have the dollars yet. You can invest those funds the day after. The only exception I would say to that is that, and this is highly unlikely, but recall that a partnership can also make an election to defer the taxes. So a partnership actually that generates this gain, they could, as a partnership, make an election to defer funds into an opportunity zone fund. That's very rare. I'll be honest, I haven't seen that happen yet, but the IRS did contemplate that. But going back to your original question, Michael, yes, you could, even though you don't have the cash yet, if you know that partnership did what you just said, you could invest it the next day.
Right, thank you. And we get a lot of these questions from investors in funds 2 and 3, because we're actually selling many assets today and we are distributing capital. So what you'll see going forward is an estimate of that distribution in terms of what is a percentage of return of capital and what is the percentage of long-term capital gains. We generally don't produce short-term capital gains. So anybody in Fund 2 or Fund 3 will see those as an update, because we get that question all the time, and you can actually turn around and invest that gain into the QOZ fund, and we will give kind of a range, because you don't know exactly how that's going to pan out until you actually have the K1, but it will be an estimate of that.
Right. Yep. Okay. Should we go into some of the forms?
Let's do it. Yeah, this is all you.
So this, you see a variety of numbers here. Some of you are probably familiar with these numbers at this point, especially if you've been investing in various funds. And if you invested in an Opportunity Zone fund in 2019, you've probably seen some of these forms here. Maybe you haven't paid much attention to them, but this is just a list of the common ones that we see here. So the very first form, you actually, as an investor, are highly unlikely to see this. This is the tax return form that an Opportunity Zone fund actually has to file. It's called the 8996. This is not something as an investor you need to see, but rest assured that every Opportunity Zone fund has to file this form. Every Opportunity Zone fund has a variety of testing and compliance that they have to go through to make sure that they're invested in an eligible qualified Opportunity Zone property, that they're spending the money appropriately, and so forth. So this is not something that you're going to see at this point, but it is it's the main form for the qualified Opportunity Zone funds. The next one is a K1. Obviously, many of you get K1s. Some of you get one. Some of you might get many. And in that K1, it shows various types of capital gains that you've had, distributions, so on and so forth. I'm sure most of you are familiar with that. We take the information from the K1 and determine, all right, here are the gains I have. How much of it do you want to potentially defer in a qualified Opportunity Zone fund? And then we use that information and we refer back to that K1 when we fill out some of these other forms. The next form that you see on here is 1099B. Obviously, many of you would have that if you're doing various types of transactions that would involve capital gains, short-term and long-term. Again, information from that is used to determine what your gains are and where you might want to invest them. So those two forms are no surprise. They've been around for a while. This next form, 8997, every Opportunity Zone investor has to file this if they are deferring gains, and you will file this form every year. So really, this form actually isn't that complicated. The IRS has made some improvements to it since what they did in 2019. And basically, this is saying, all right, if I make a new investment in an Opportunity Zone this year, I need to document that. And then I also need to highlight how much in total investments do I have each year. You will file this form every year on a go-forward basis, because you're going to need to say, how much Opportunity Zone investments did I have at the beginning of the year? What did I sell? What did I buy? And what does it look like at the end of the year? So it's fairly straightforward at this point. I will say that I think this form is likely to be expanded in the future, because there has been a lot of push from, probably bipartisan push, but probably more from Democrats, to see reporting on Opportunity Zone investments. Where did you invest that money? What type of impact has it made? I think probably more of that reporting is going to fall on the Opportunity Zone funds themselves, but I ultimately could see that you as individual investors might be in a position where you would have to do additional reporting, perhaps on this form, to say, look, these are the investments I've made, and here's a report from the fund as far as the impact it made. So, Michael, this is probably no surprise to you as the fund managers and so forth that, Congress as a whole has talked about requiring more reporting, right, for what you're doing. At this point, it hasn't come forward, but I could certainly see that coming with tax reform over the next year or two.
Yeah, we're not really concerned about reporting. We fully comply with QOZ laws. I think the biggest thing that might happen is that the maps were drawn via the 2010 census, and they very easily could, and they likely will, just reconfigure the maps based on the 2020 census. I don't think anything retroactive will matter, but going forward, it'll change the zones, and it actually could provide some great opportunities for us because it'll open up new areas.
Right. Keeping with the forms here, another form on here is form 8949. So again, this is not necessarily a new form, but it's a form that you do have to document, what qualified opportunity zone fund investments you are in. So Origin provides this information to you every year, from the standpoint of when did you make your investment into the fund, what's the EIN number of the fund and so forth. And of course, how much in taxes are you deferring in here? So this is not a new form to you, but you will need to document on there when you've made the opportunity zone investment and what fund you're in and how much you deferred. One thing I want to point out, when the IRS, basically created all these forms, I guess they did it for the 2018 year, but very few parties invested in opportunity zone funds in 18. Really, we started to see a lot of investments come in 2019. And, the IRS cranked them out pretty quickly. There was I help a lot of different CPAs, consult around opportunity zones and help them with these forms. There was a lot to be desired and to improved. Certainly the IRS has made improvements to these forms for 2020, and they are a little bit clearer. They're still not perfect by any means, so I expect there'll be changes to be made. The one thing that I really want to caution folks on is that, whether you do your taxes yourselves or you have a CPA or other tax preparer that helps do them, the software programs may or may not have picked up on all of the various notations that you have to make for opportunity zone investing. It's not all that complicated, but as you can imagine, every year teams go in and they, make improvements to tax software, and not everything is caught. So one of the things that I offer when, clients will come to me and say, hey, can you help me with the opportunity zone reporting on this? What do I need to document? How much can I invest, and so forth? I help draft the forms. And then I'll say, all right, provide this to your CPA, or, if you're doing TurboTax or whatever it is, then let me see what the forms look like once it runs through the process to make sure all of these things are reported properly. So I just want to point that out, that it's very important to look at. So another form that you would have, if you could go back to the prior slide, 4797, this will apply to some investors. Just keep that in mind. Schedule D, again, that's going to show up on basically every opportunity zone investor. That's nothing new. And then, of course, the last form is 1040. That's nothing new there. But all this stuff will ultimately flow through to your 1040. So that's a list of forms. Obviously, there could be some other ones, especially if you have trusts and other things that are going on. But these are the main ones that we're seeing for most opportunity zone investors.
Great, thank you, John. We actually have a flurry of questions coming in. And John, I want you to answer, I guess, specifically the question. I'm not sure if you have this information, but there's a lot of concern from investors talking about the 180-day rule. So let me find this investor's question. This is from Mitchell. And Mitchell says, the regulations say 180 days from when the return is due from partnership. So it's September 15th for partnership returns, right? So for 2020, is it September 15th or is it June 28th?
Well, the timely filed partnership is due, or was due, March 15th, right? But most partnerships will extend until September 15th, right? So what we had clarified last year for COVID relief was that you could certainly extend until September 15th of last year. And I believe that was extended for this year, but honestly, I have to double check on that. The last notice that the IRS issued on this that I'm aware of was notice 2020-39. And I believe they extended it through September 15th of this year, but I am not sure on that. I have to double check. and I do not want to make sure that I want to make sure that I don't issue
Right.
false information. I know it's
Well,
a very
I
big
think-
deal.
Yeah,
So-
there are a lot of questions coming in from
Yep.
investors who are panicking about this date. So
Yep.
please check on that. And it's likely, and I also remember that it is September 15th. So in a typical year, it's going to be the June 28th, 29th, 30th, 180 days. But I believe there still is some COVID relief this year. So don't panic right now.
Yep.
Yeah. Okay, let me, John, that's been great. We've only got a few minutes left. Let me ask some of these questions. And some of these are specifically related to contacting contacting us. And I'll just say that if you are interested in the Origin QOZ Fund and you want to learn more about that, you can go to our website. You can download those documents directly from our website, or you can reach out to anybody, one of our individuals in investor relations. You can do that via the website as well, and they're happy to have a conversation with you, answer your questions, tell you all about the Origin Income Plus Fund. So those are the two ways to get in touch with Origin. John, how do people get in touch with you?
Yeah, by far the best way to get in touch with me is via email. You can also go to my website, bracketpartners.com, and then of course you can click for info there and that goes to my email, but the email is by far the best. I do have individuals that call me a lot, but the best way is to send me an email. And if I can answer the question, great. If not, then what we'll do is we would just set up a follow-up time for a call. So email by far is the best.
Great, thank you. I'm going to see, I believe most of these questions we have gotten to in one way or another here. So this has been fantastic, John. I really appreciate your time today. Everybody, if you have questions that haven't been answered, please, you can email John, email me. My email address is michael@origininvestments.com. I will forward those on to the right person, whether that's John or our internal legal counsel, Mike McVicker as well. So thank you for your time, everybody, and enjoy. Thank you. Bye.
All right. Thanks, everybody.
Thanks, John.